All right, thank you. So, those of us who had the opportunity to join us last week, it was a great section introducing us to tax audit and investigations, going through a number of key concepts. We touched on a number of things, and in the next couple of weeks, I know and believe that with whatever we will be going through, it's enough for you to pass your exam coming sitting, like the next sitting, I mean. So today is also going to be a little packed, but I'm going to make it as simple as possible for us to basically understand, know how exam questions relating to those areas could be, and also assist in explaining key concepts that are fundamental to our understanding to these concepts. So today we are going to look at pre-contact procedures, or what we also call pre-audit research. You look at analytical procedures. You look at some sort of risk assessment. We would also look at what an entry conference is, or what people call entrance conference, or what people call entrance meeting. It's still the same thing. Then we are also going to look at quality control. Then we look at internal controls as well. Then after looking at all these, I would also want us to touch on maybe a few past questions and know how these past questions operate in some of these areas. And most especially as I move along the class, I'll be providing you with examples. I'll be providing you with how past questions could be, or how questions could be set in areas of discussion for today. So in the next 1 hour, 30 minutes, we are going to have a discussion around these key concepts. And I should tell you, these are fundamental to our passing, and we need to have a grasp of these concepts. Okay. All right. Let's look at pre-audit research and planning. So here, before you begin your audit, you need to plan. Okay. You need to plan. And for every audit, without planning, the audits would have like a lot of bottlenecks, or let me say a lot of issues going ahead, because you've not planned and you want to have an audit done. You're going to have an issue because you don't really understand, or you might not really understand what you are going to do. You will not be able to envisage the risks that purportedly can come your way during the audit, and how to even address them. So basically, you need to plan before you start an audit. Now, in tax audit, we call something pre-audit research, or pre-contact procedures. Before you come into contact with the taxpayer, there are some necessary procedures that you need to conduct, or you need to undertake before you start your audit. Now, typically, at a GRA setting where you want to audit company A, the processes that you go through before you start auditing company, you need to do some form of background research about the company. So your head of audit, say, would assign a test case to you that, okay, Amma, you are going to audit company A, and you need to do a pre-audit research about these companies. So this is where you gather a lot of information after it has been assigned to you. You do a background information gathering and analysis, analyze the taxpayer file. So you go and pick the taxpayer file. Try to go through the taxpayer to understand what the taxpayer do, to understand their compliance history, to understand some of the correspondences between the taxpayer and GRE, to understand some of the things that goes on between them. Okay. Now, after doing that analysis, you in the process identify potential risk. So in identifying potential risk, you say, okay, this company had not been filing their returns on time for some time now. This company, looking at their financial statement and looking at the VAT they are paying, and looking at the amount of the kind of service they render, it looks like all their services are vatable, and their VAT on just a test case is not making sense. So you are identifying risks, the taxpayers' compliance history, they're not paying on time, some of the risks that you envisage in the taxpayers' business, and all that. Correspondences between GRA and the taxpayer, you realize that maybe they have previous unsettled tax audit liabilities and all that. So it gives you an idea about the risks associated with the taxpayer. Then you determine the scope of the audit. What are you going to cover in the audit? Are we going to look at, let's say, only CIT because that is where we envisage a lot of risk? Are we going to look at all tax areas, right? Then you document your conclusions as to what you want to do on that particular client. Then you discuss with your supervisor or your head of audit. So this is the pre-audit research. Is it well understood? And this is an activity that is supposed to be carried out before you do your audit. Okay. Now, this is normally done in the office. So at this point, you've not visited the taxpayer's premise yet. Okay. Now, there are two key activities that is prescribed for every tax audit team to perform before actual and proper audit starts. Okay. One, the first one is the initial interview with the taxpayer. And the second is also the tour of business. These are all planning.
You just go and come.
Okay. These are all planning concepts. These are all planning concepts. So after you've done your pre-audit research, you know your scope, you know what you want to do, you know the kind of procedures you want to conduct and all that. Now, you need to do what we call your initial interview with the taxpayer, as well as your tour of business. Now, let me first talk about the first one being the initial visit to the taxpayer, which is basically where you conduct like interviews. Okay. Now, your initial visit to the taxpayer is just to familiarize yourself with the taxpayer's business. In familiarizing yourself, you are asking the key questions, you are getting clarity to the necessary questions. Maybe after going through the taxpayer's file, you do not understand certain concepts. After going through the taxpayer's file, you need clarity on certain matters. You need to find out something from the taxpayer. This is an opportunity to have an initial discussion with the taxpayer. This meeting does not begin the audit. This is just a meeting just to familiarize yourself with the taxpayer's premise. And normally, this is the kind of meeting that you can even serve them the planning letter and say, oh, we want to do an audit on this day and all that. So you have an initial visits to the taxpayer's office, and this helps build rapport with the taxpayer. Okay. Now, during the initial interview, there are certain things that, or the initial visit to the taxpayer's office, there are certain things that you can ask. Okay. You need to let them feel that you are not there to police them, or you are not there to collapse their businesses, as many taxpayers would think GRA officials have in mind. This should be something that you want to just familiarize yourself and understand proper what they really do. So here, you can ask them about the summary of their businesses. You can ask them how the financial year had gone. And most importantly, with some of these meetings, you talk to the relevant people. Okay, so you can place a call to the taxpayers' premise. Normally from their file, you have their permanent information. So you're able to see their address, their contact numbers and all that. And book a meeting with a senior person and ensure that maybe the CEO or the managing director is in the known, because you cannot go there unofficially as a surprise. Okay. Now, you can clarify points that you have already established from the file. Maybe you saw that they are not filing on time. Maybe something peculiar might have happened. You just want to find out why deliberately they are not filing on time. Okay. Now, in conducting the interviews, during your initial meetings, you should have some skills. Okay. There is a way the interviews are supposed to be conducted. So one, you should ensure that these interviews are done with knowledgeable persons, people who are able to give you information, especially people who are in the accounts office or the accounts department, because they will normally deal with auditors. Also, you shouldn't make it like more of a question to answer section. It should be a conversation. It should be a conversation, okay? So that they feel you are not there to harm them. Also, there are instances where we do such interviews and the taxpayer feels that we are not really thinking about them. Like I remember when COVID came, you go and do an initial visit to the taxpayer's office, then you ask the taxpayer, oh, sorry for the impacts of COVID. We know business had been slow and all that. Personally, the other taxpayers I audit, they were also impacted by COVID. It is such a downtime for most companies around this time. We from GRA are very sorry for these challenges, and we hope and pray that the company revamps its activities in the coming days, because your well-being impacts on the well-being of GRA as well. So I'm grateful to feel a part of your company, and I pray that things go like as expected for you in the coming years. And we know this year might not be as expected, but we hope that things get back on level ground. If a GRA person makes these statements to a taxpayer, the taxpayer will feel, oh, no, and these GRA people, they think about us, so they really think about us. We do not know when they come for tax audit, it's just to come and take our money. So you see, the interview must let them feel or have the feeling that you are part of their business. So even normally, if you want to even ask them something about the company, you can just start with something you know about the company already. Okay, so you start with something that already hits your mind. Maybe you know that the company is into ABC. Can they tell you more about what they do? You understand? So that they know you are a part of them. Okay. So these are some of the things that we should note, okay, when doing this interview. Now, after the initial visit, you can also do what we call a tour of business. In practice, normally the initial visit is done, but the tour of business is missed out on some cases, most especially depending on how the operations of the company is, okay? Now, if you are talking about tour of business, as the word suggests, you are touring the company's business to know the processes involved in what they do. So this is different from the initial visit where you get to know more about them, clarify matters and all that. The tour of business is touring their company to know what they do and also to know the processes involved in whatever they do. So maybe, for example, you visit a company at Tema, it's a manufacturing company. You want to know how goods moves from the warehouse to the finished goods department. So how the processes are done, the processes involved, how they do their invoicing, the kind of clients they have, how long did they take to pay, just getting an understanding of the processes involved in the company's business. So that's what we call a tour of business. So normally you tour the type of activities that they do, maybe about their assets. You ask, so how long have you had this building, or how long have you rented this building? They are asking questions, they are touring around. This is not like a meeting they sit. They tour around, ask questions, engage with the employees. Okay, so that is what we call tour of business. Okay, tour of business. All right. Now, at this point, can someone explain to me like the difference between tour of business and the initial visit to the taxpayer's office? I just need someone to give me like a one-line statement, just to confirm that the understanding is perfect. Anyone to give a try? Or what I explained, no one understood.
Can I give a try?
Yeah, Miriam, go ahead.
Okay, so the initial visit is basically to confirm the initial information you have about the business based on your pre-planned activities you've done in the office. And the tour of the business is you being in the premises, having discussions with employees, the people that matter, to really confirm the initial information you have about the business.
Okay, all right, thank you. So in summary, the initial visit is just to visit the taxpayer to have a meeting with them to understand certain things that you didn't know more about the company and to clarify matters from knowledgeable persons with regards to things that you have done already from your office. Tour of business is to know how processes work with the company. So the kind of things they do, the processes that they go through to sell their products and all that. So that's basically it. Now, in doing audit planning, okay, there is one key thing that auditors look out for. Anything that does not sound like looking like something that is used in a normal course of business, auditors normally flag it. So let me give a typical example where you are auditing a company and you know this company is a relatively small company. So you don't expect to see maybe high revenues in their financial statement or maybe in their ledgers. You go through their ledgers and realize that, hey, someone bought something and the person paid about 100,000 Ghana cedis. Normally, you see their sales maybe 20 cedis, 70 cedis, 200 cedis, 1,000 cedis. But to see 100,000 as a one-time transaction, it's very unusual, and you think it's not something that is normal in their course of business. Normally, auditors draw their attention and their mind to some of these things. This brings us to what I want to explain, called large, unusual, and questionable items. Okay, so in short, LUQs. LUQs are items that they do not look normal, or they are not things that we normally would consider in the normal course of the company's business. They are quite unusual. So as the name suggests, large, it means that large will trigger something. It is large than what you consider the company to have. Unusual, it doesn't follow the normal pattern that it's supposed to follow. Questionable, it means that you have some questions around it. So large, unusual, and questionable items are things that auditors, we normally avert our minds to in doing our audit. And in doing tax audit, there are a lot of things that you come across which would show or depict characteristics of something that is large, unusual, or questionable. Okay. Now, what are some of the factors that you consider as an auditor when you are looking out for some of these large, unusual, and questionable items? One, you look at the comparative size of the item. As I explained, if you are looking at the company's sales and you see that normally sales are coming 1,000 cedis, 200 cedis, 70 cedis, and all that, you see a one-time sale of 100,000 Ghana cedis. It is so large, and the comparative size of the item together with other transactions is going to be a problem. You see that to be something that you need to interrogate. So that becomes an LUQ. An absolute size of an item. So here, we are not looking at comparing it to, let's say, other items in revenue or sales. Here, you definitely stand and say, if someone comes to your company and buys something of 50,000, for example, 50,000 Ghana cedis, it's a big deal. It's like, don't even compare to other transactions. 50K is material. So we say, okay, looking at the absolute size of 50K, it's something big that, oh, let me just look into it, because 50K is big. It might not be an item that comparatively to other items will look so big, but then once a company is able to make 50K in one sale transaction, it means that it is a big amount. So that's what we call the absolute size of the item. Evidence of intent to mislead. Evidence of intent to mislead. So sometimes you see taxpayers presenting some information to you that you feel they might want to mislead you. These are basically and purely based on your professional judgment, okay? I can give 1,001 instances where a taxpayer would attempt to mislead a tax auditor, okay? I can give 1,001 examples, but then depending on how your audit goes, based on your professional judgment, you are able to tell this taxpayer is giving me this information just to mislead you. For example, they can give you a lot of information you might not need. Maybe you ask for ledgers. They will give you even the ledger in a particular way that you cannot even make sense out of it. there's an intent to mislead. So you have to be careful as auditors, using our professional judgment to be able to tell if something is unusual with the taxpayer. Maybe you're asking for a common salary or like payroll. Then the payroll will be encrypted. You can't even see the formulas and everything. Like, for example, you ask, why is this thing structured this way? They'll tell you that's what they have. They can't do anything about it. But this is a normal Excel. And based on your understanding, computer-assisted techniques or some of these Excel stuff are supposed to be things that GRA, as once you transfer to us, our laptop to be able to view it and manipulate it well. Otherwise, then you are preventing us from having access to the information. So that's a pure intention to mislead. And it is considered as a large and unusual and questionable item if you are presented with such an information. Then missing items, the same thing. They can give you something and you have done audits, tax audits, and there are times that I request for contracts of directors or contracts of senior management. They'll give you the contract, you look through, you realize that sections of the, so let's say you see clause 5.1. 5.1 states maybe the managing director or the chief financial officer is entitled to bonus at the end of the month. Then you go to the next clause, it's showing 5.3. You are not seeing 5.2. So if you are not careful as an auditor, you not see all these things. So I go to the head of finance and ask, I'm reviewing these contracts and there are missing clauses or there are missing sides of the contract. He tells me that yes, those missing ones are also kept separately in the managing director's office. Okay. I believe some of us will understand some of these things, and sometimes because of confidentiality issues and other things, the other staff in the finance office are not supposed to have access to all these missing clauses. Okay. So if you do not have a good eye and you are not careful, you'll not be able to determine that that item is actually missing. Okay. So sometimes you need to exercise more professional judgment, look into whatever you are looking into very well. And for me, I requested and they had to bring those missing clauses and I reviewed as well. So it helps. It really helps. Okay. Now, one other point I can add is the inherent factor of the items. So sometimes when you are determining large, unusual, and questionable items, looking at the inherent factors, okay, of that particular item, if I say something is inherent, it means the thing is in it. It comes with it naturally. Okay, it comes with it naturally. So normally for things like, let me give you an example, repairs and maintenance. Okay, we are all aware, or if you are not aware, one of the sections that was revised from the old Tax Act. So previously we used to have Act 592. So that was the Income Tax Act that was repealed in 2016 and overtaken by Act 896. Okay, Act 896 is the Income Tax Act. Okay, Act 896. Now, when 896 came into force in 2016, previously, if you have repairs and maintenance in your financial statement, the entire amount was allowable for tax purposes. So you then allow repairs and maintenance expense as an allowable expense, meaning that GRA would accept that expense as an expense and will not add back when they are doing your tax computations. When 896 came into force, they introduced Section 12, repairs and improvements. And this section of the Act states that anytime a company has repairs and maintenance expense or repairs and improvement expense, it must be limited. So based on the inherent characteristics of repairs and maintenance, there should be a limitation on the repairs and maintenance expense. So based on its inherent characteristic, anytime you see repairs and maintenance, okay, you don't pass by. You need to ensure that the limitation has been done correctly so that you ensure that the amount in expense is correct. Okay, what does the limitation say? It says that Section 12 says that repairs and maintenance must be limited to 5%, okay, of the written down value of the value of that asset at the end of the year. So let me break it down. If you are looking at repairs and maintenance for motor vehicles, the company has spent a lot of repairs and maintenance for motor vehicles. This is what the law is saying. When you go to your capital allowance, okay, you look at motor vehicle, the class motor vehicle. So motor vehicle falls in class 2. We'll be looking at capital allowance soon, so you understand what I'm talking about. Motor vehicle is class 2. Now, you are going to look at the written down value of class 2. In accounting, we call the carrying amount or the net book value. In capital allowance, you say the written down value. So you look at the written down value at the end of the year. That amount, okay, you are going to calculate 5% of that written down value at the end of the year. And that should be the highest amount of repairs and maintenance you can allow in your financial statement as an expense for motor vehicles. If it's, let's say, fixtures and fittings, repairs on fixtures and fittings, it's also limited to 5%, a maximum of 5% of the written down value of class 3, which has fixtures and fittings at the end of the year. Now, if the repairs and maintenance expense exceeds this threshold, the excess is going to be disallowed. Okay, so we will get to know more of that when we do capital allowance. And so, someone will ask, why is GRE disallowing the excess? What benefit does the taxpayer get? The benefit is that it is going to be added as an additional asset to be granted an additional capital allowance in your capital allowance computations. It is more or less like GRE foresees that, so this is the spirit behind this law. GRE sees that a lot of companies are putting a lot of capital expenditure under repairs and maintenance. And say if that happens, it means that the company is going to have a lot of expenses, which is going to take a toll on their revenue, leading to lower profits, leading to lower taxes. So if, let's say, you buy a car and you replace the car handles, like the car doors, the car, replacing all 4 doors of the car can even be like half of the price of the car. You have to capitalize it as an asset and not bring it as repairs and maintenance. So this is tax planning, so that GRE will not come and disallow that expense for you when they come to do their tax audit. So normally, the repairs and maintenance ledger must be kept clean, and items that are capital in nature must be taken off that ledger. Okay. All right. So basically, I'm just explaining to you why repairs and maintenance would be an unusual and questionable items because of the inherent nature it possesses. You need to look at it. Okay. Okay. Let's move on. Now, I want a few of us to tell me what are some of the importance of audit planning from what you have discussed. Okay. Audit planning. What do you get if you plan well? Okay. So let me just go through the points I have here. 1, it helps you identify risk and pay attention to key risks that you identify during the planning. It gives direction to the team. Once you plan ahead, you are able to get direction as to what you actually want to do on the taxpayer's premise. Also, it gives you a fair idea of the work ahead that you want to undertake. It helps you allocate work to staff. So when you plan well, you know, okay, this is risky. Let me give this risky area to this experienced person on the team. Okay, so it helps you in allocating, tax allocation. It also helps you in preparing your time budget. So once you plan, you know how many weeks you have to spend on the tax audit. So it helps you in doing your time budget, knowing the composition of your team and how best you can finish up the audit within time. Okay. All right. Let's look at analytical procedures. If I say analytical procedures, as the word suggests, you are being analytical with the kind of information you have, trying to analyze it to bring out basically any risk that you foresee. Analytical procedures is a risk assessment tool that auditors use a lot. Analytical procedures does not mean a particular style of doing things. It basically connotes how an auditor is able to analyze information, analyze changing patterns, analyze changing trends with information, analyze possible fluctuations, and based on that, the auditor is able to know some of the risks involved in that particular information they're analyzing. So basically that's analytical procedures. We have three basic types of analytical procedures. Let's note this in exam. When you are asked of the types of analytical procedures, they are different from the forms or instances where analytical procedures can be performed in an audit. Okay, so the types, we are talking about three basic types, which is one, comparing the company's information to the industry information. So you are comparing company A's information to the industry information, benchmarking on how the company has performed. Type 2, you are comparing the company's current performance to prior year performances. So you are able to benchmark and see fluctuations in, let's say, the current year, the company had a revenue of 100,000. The previous year, the revenue was 200,000. What has changed? What is causing the difference? What is causing the fluctuation? Are there any risks here? Has the company lost key customers, or has the company lost out on their marketing strategies, or the company is facing fierce competition from a new company who is taking over the market? Okay, so these are some of the risks that you think about. Then finally, so first one, compared to industry information or a competitor's information. Okay, then second one, you compare your current periods to prior periods. Then finally, you compare the company's actuals to their budgeted amount or estimate. So here you can look at how the company has performed based on the budgets they made at the beginning of the year and currently the actuals that they have, knowing whether the company actually budgets well, knowing how the company does like their things and all that, in terms of getting to know fluctuations within amounts they budgeted for and amounts that actually pertains to the actual transactions that occurred within the year. Okay. Also, analytical procedures can be done within at three stages or three situations. So these are the forms that analytical procedures can take, or instances where you can perform analytical procedures. At the planning stage, as I told you, you are analyzing information, so this can be applied anywhere. At the field work stage, when you are doing your tax audit, gathering information, you can employ analytical procedures. And at the completion stage, where you are concluding on your audit, you are concluding on your tax audit report and all that, analytical procedures can't be what? Can be applied. Okay. When the call ends, let's kindly rejoin so that we look at a key risk assessment tool, which is ratio analysis.